So on Saturday, we went through the volunteer standards of conduct. We talked about the quality review, intake, and interview training. We also went through setting up your Link and Learn account. And so at some point on today, we'll go through and show you what the practice lab looks like for those of you who do not have access to the practice lab, so that you are able to see what that looks like. And so on tonight, we'll jump into the tax law portion of the training. Before we do that, I did receive one question, and that question asked about the publication 4299 and what that was. And so I am going to share my screen. So I think I had the publication up. Let's see. Yes. Can you all see my screen?
Yes.
Mm-hmm. So the publication 4299 is your privacy, confidentiality, and civil rights publication. And so what that publication does is it basically goes over and give you more in-depth information as it relates to information that I previously gave in your volunteer standards of conduct, as well as your intake, interview, and quality review training. It advises you of what happens if you don't follow the volunteer standards of conduct. It gives you more information on taxpayer privacy, how you are protected under the Volunteer Protection Act of 1997, or the VPA. It gives you background information on how information provided by individual taxpayers to the VITA TCE sites or to those volunteers, how that information is used, how it is protected, things of that nature. And so you will find throughout the training, throughout any material that you read for VITA TCE, it will refer you back to this publication 4299 for you to get a better understanding of what your rights as a volunteer is, what your due diligence also is as a volunteer, and what some of the stipulations you are required to adhere to as a VITA TCE volunteer. All right. So again, this publication is available at irs.gov, along with any other publication that you will need, or that any other reference material that you may need during your time as a volunteer with the VITA TCE program. Any questions or concerns as it relates to the publication 4299? So as I stated on Saturday, we did talk about the volunteer standards of conduct. And if you remember, there are 6 of those, and we talked about what those 6 were, as well as your failure to comply with those volunteer standards of conduct. Again, we talked about the intake, interview, and quality review process, what your due diligence is in ensuring that you verify identity to help prevent identity theft, and what it is that you need to do in order to do your due diligence as a VITA volunteer. I left off on Saturday asking that if you got a chance, or if you had the opportunity for you to read important changes for 2024, as well as temporary provisions. If any of you had a chance to look over that information, were there any questions or concerns for that information? Or did anyone have a chance to read over the important changes for 2024, or the temporary provisions? Are you all still able to see my screen? Yeah.
Yes.
Yes, I'm able to see your screen, and I did not read the important changes.
Okay, that's fine.
Yes. Okay.
I'll go over what those are. I won't read all of the information as it relates to the important changes for 2024. That information is available in the publication 4491. But I will hit on some of what I believe is most important for you to know, and I will advise for you to go back and read in depth that information. All right. So the important changes for 2024, the due date for filing individual income tax return as of the date of this publication is April 15th, 2025. There were some forms and publications, some forms and schedules as it relates to the Form 1040 that had some changes to it. The Form 1040, which is the U.S. individual income tax return, now includes a checkbox and entry field in the filing status section that allows taxpayers to elect to treat a non-resident alien spouse or dual status alien spouse as a resident. A checkbox was added on line 6C. Taxpayers who elect to use the lump sum election method for their retroactive payment of Social Security benefits would check this box. There was also a change added to Schedule 1, which is a schedule attached to the Form 1040, which deals with the additional income and adjustments to income. The Form W-2 wage and tax statement now includes a new Box 12 Code 2 for Medicaid waiver payments that have been excluded from income under the notice 2014-7. Taxpayers will receive Form 1099-K payment card and third-party network transactions when reportable proceeds exceed $5,000 for 2024, although they may receive the form at a lower amount. This threshold applies to third-party settlement organizations. Taxpayers are required to report all taxable income on their federal income tax return, regardless of amount or if an income reporting document is received. Form 1099-K payment card and third-party network transaction is something that we will cover later in this training. Publication 1244, Form 5329 are two other, is another publication, another form that have changes made for the 2024 tax season. The Form 8888, which is the allocation of refund, was changed for this tax year. It now is will only allow taxpayers to split a direct deposit refund between two or more accounts, or to split a refund between a direct deposit and a paper check. You used to be able to use the Form 8888 to buy to deposit refunds to a Treasury direct account to buy savings bonds, as well as paper bonds, but that has been discontinued for the 2024 tax year. There are some new provisions. The waiver of the 10% additional tax on early distributions for emergency personnel expense distribution of as much as $1,000 beginning in 2024. The distribution may be repaid within 3 years from the date of distribution. There was a change to the qualified tuition program, or the QTP. And also it states, and beginning in 2024, domestic abuse victims may distribute the lesser of $10,000 or 50% of accrued benefit from an eligible retirement plan without the 10% early distribution penalty. It refers you to the publication 575 for more information on that. The personal exemption amount is still suspended or reduced to zero. That became effective for tax years 2018, and it goes through tax year 2025. The deduction allowed for elementary and secondary school teachers remains at $300. That has not changed from last year. The standard deduction for 2024. For taxpayers who do not itemize deductions on Schedule A has increased. There was an increase of $1,500 for married filing joint or qualifying surviving spouse, $1,100 for head of household, and for single or married filing separate, that standard deduction increased by $750. For taxpayers who are 65 and older or are blind, for single or head of household, that standard deduction increased by $100. For married taxpayers or taxpayers who are electing to file as qualifying surviving spouse, that increased by $50. For 2024, the standard deduction amount for an individual who may be claimed as a dependent by another taxpayer cannot exceed the greater of $1,300 or the sum of $450 and the individual's earned income. For anyone claiming the kiddie tax or anyone subjected to the kiddie tax, the individual must have unearned income of at least $2,600. For the standard mileage rate, for 2024 is 67 cents per mile for business miles, 21 cents per mile driven for medical or moving purposes, and 14 cents for in-service miles driven for charitable organizations. The deduction for qualified business income for 2024, the threshold amount is $383,900 for married filing joint and $191,950 for all other returns. The retirement savings contribution credit, the taxpayers for 2024, the taxpayers' modified adjusted gross income must not be more than $38,250 for single or married filing separate or qualifying surviving spouse, which was an increase of $1,750. For head of household, it increased by $2,625, and for married filing joint, it increased by $3,500. Earned income credit for 2024 increased for 3 or more children is $7,830, $6,960 with 2 children, $4,213 with 1 child, and taxpayers that qualify with no children, $632. Earned income and AGI amounts also increased for the earned income credit. Taxpayers whose investment income is more than $11,600 cannot claim the earned income credit. For child tax credit and the additional child tax credit, that refundable amount of the credit is $1,700 for the 2024 tax year. Taxpayers claiming the student loan interest deduction, that deduction begins to phase out for taxpayers who have a modified adjusted gross income of more than $80,000. For joint taxpayers is $165,000. That deduction is completely phased out for taxpayers with a modified adjusted gross income of $95,000 or $195,000 or more for joint returns. For 2024, the maximum amount of qualified charitable distributions that are not includable in gross income is $105,000, which is an increase of $5,000. That maximum amount applies to each spouse if filing jointly. For 2024, the maximum amount of qualified long-term care premiums includable as medical expenses has increased. For 2024, the maximum foreign earned income exclusion is $126,500. For IRA deductions, amounts and modified adjusted gross income limits for traditional and Roth IRA contributions, the combined traditional IRA deduction or Roth contribution is now $7,000 or $8,000 if the taxpayer is age 50 or older. The premium tax credit The advanced premium tax credit repayment caps for 2024 are listed there. That information is available in this publication 4491, and we'll also go over that. It may be covered in our premium tax credit lesson, but you can also find this information. You should be able to find this information in your publication 4012. The health savings account deduction for 2024, the annual contribution limits on deductions for HSAs for individuals with self-only coverage has increased by $300 to $4,150 and $8,300 for family coverage, which is an increase of $550. There is an additional contribution amount of $1,000 for taxpayers who are age 55 or older. It refers you to the publication 4491X, which is the VITA TCE training supplement. That's available at irs.gov. So if any additional legislation has been passed since this publication came out, you will find that information in the publication 4491X. Any questions or concerns as it relates to changes relating to the 2024 tax year? No, Miss Deborah, you're asking, can anyone come for the free tax prep? No, so there is an income limitation, and I think Hunter, we put that in the chat on Saturday. I can't recall what it was.
67,000 this year. It
67,000.
changes each year.
So no, so they have to be, in order to qualify for the VITA TCE program, it is an income-based limit. And so for this year, the limit is 67,000 for them to be able to qualify for that free tax prep.
Hello.
Hi.
Hi, this is Phyllis. I have a question for you guys.
Okay.
Do you see a lot of people in there that really has an income of 67,000?
Yes. Who meet the criteria?
Yes, I know. I see with me having worked for tax officers, I saw it was a few people came in more after the earned income credit folks. That's why I was asking. Did you see a lot of people in there with an income of 67,000?
Yes. I mean,
Okay.
yeah, so you have some that are even over the limit that we have to turn
Okay.
away. And so
Okay.
all they see is free tax prep. And so they just want that. And so you have
Okay.
some that don't even realize that they've made that much. And so they may have had multiple jobs, or
Yes.
have some that have W-2, but they also have Social Security or retirement income and still not realize that they've hit that 67 or whatever that limit was for the year.
Okay.
But for the most part, we do have, low income taxpayers who don't reach that 67 or 60,000, whatever that limit is for the tax year. And they are able to receive the earned income credit, but for some, you do have some that are just at that limit.
Okay. Now I know a lot of teachers I have dealt with was at that threshold. That's why I asked. But I don't really supposed to be doing taxes. I'm supposed to be helping an assistant in the office. I missed you Saturday. I got to get with you about picking up what I didn't get Saturday. My name is Phyllis.
Okay.
And I have been sick. I'm still a little sick, but I'm getting over it.
Okay. So so I'll put my email address in the chat again tonight, and so you can reach out to me whenever you have a chance.
Okay. And what is the best time to get in touch with you?
Anytime. So you can email me at any point.
Okay, then. Thank you. Then.
All right.
I have a question.
Okay.
Is that 67,000 limit gross?
I think it's total income, because we're not able to, when the greeter or screener is doing the intake, they're not able to determine whether or not the adjusted gross income is going to be $67,000 or, so they're not, they can't figure out if with deductions, your income is going to be 67. So so what they're looking at is a total of your income. And so if a taxpayer is coming in and they have 5 W-2s, they're looking at the W-2s to see what that W-2 income looks like, or to see whether or not you qualify for.
Okay, and they are just looking at before taxes and deductions, that total amount?
What do you mean before taxes and deductions?
Well, on the paycheck, you have taxes and there's the gross amount that you get.
So no, they're not using paycheck stuff. They're using W-2, whatever.
Okay,
financial
I
documents that
got
they're
you.
using,
Yeah,
W-2s, 1099s, things of that nature. So
gotcha.
they're not going to look at a paycheck stub or anything like that. They're looking at whatever wage and income documents that taxpayer has, W-2s, 1099s, Social Security statements, all of that, to determine what that taxpayer's income is for the year.
Gotcha. That works. Thank you.
Any other questions? Okay. We went through the course introduction on Saturday, just giving you an overview or look into what this training will give. Let's see. There is some temporary provisions. Let's see. So Hunter has put some information in the chat as well. There are some temporary provisions that were out or that came out at the time of this publication. And so it's that some of the provisions contained in this lesson have been commonly referred to as extenders. Others are temporary provisions contained in recent legislation. In some instances, these provisions modify only portions of the existing tax law. In those cases, we have included caution statements in the effective lessons, redirecting volunteers to explore the temporary modifications in this lesson. The following topics are covered: student loan forgiveness, employer-provided educational assistance, cancellation of debt on a principal residence, and the expansion through 2025 of the premium tax credit, which is covered in the premium tax credit lesson. So for student loan forgiveness, an exclusion from gross income is available for student loan forgiveness after 2020 and before 2026 for most forgiven student loans. If eligible for the exclusion, the lender should not issue Form 1099-C. Exclusion for certain employer payments of student loans. Employers may provide a student loan repayment benefit to employees on a tax-free basis. Under the provision, an employee may contribute up to $5,250 annually toward an employee's student loans, and such payment would be excluded from the employee's income. The $5,250 cap applies to both the new student loan repayment benefit as well as other educational assistance provided by the employer. This provision is extended through 2025. Cancellation of credit card debt is included in the other income lesson, and we will go over that for advanced certification. Exclusion from gross income of qualified principal residence indebtedness is extended through 2025 on a modified basis. In scope for VITA TCE programs, it refers you to the publication 4731-A, which is the screening sheet for foreclosures or abandonments and cancellation of debt to ensure that the tax return being prepared is within scope of the VITA TCE program. This screening sheet is contained in the Volunteer Resource Guide Legislative Extenders tab. And so it's going to always refer you back to your Volunteer Resource Guide, which is your publication 4012. And that refers to taxpayers receiving the Form 1099-A for foreclosure or abandonment of their principal residence, as well as a cancellation of debt for a home mortgage loan. I've never seen a lot of this in the years that I've been preparing returns through the VITA TCE program. You may get one or two that have a sale of a home, or foreclosure or abandonment or cancellation of debt. It's not usual that you would see this type of information or forms at a VITA TCE site. This talks about recourse versus non-recourse debt. There are two types, recourse and non-recourse. A recourse debt holds the borrower personally liable. All other debt is considered non-recourse. In general, recourse debt or loans allows lenders to collect what is owed for the debt even after they've taken the collateral. Lenders have the right to garnish wages or levy accounts in order to collect what is owed. A non-recourse debt does not allow the lender to pursue anything other than the collateral. For example, if a borrower defaults on a non-recourse home loan, the bank can foreclose on the home only. The bank generally cannot take further legal action to collect the money owed on the debt. Whether a debt is recourse or non-recourse may vary from state to state depending on state law. If a lender cancels a debt and issues Form 1099-C, the lender will indicate on the form if the borrower was personally liable for repayment of the debt. We will go over Form 8949 and Schedule D in one of the later lessons that we cover when we get into more tax law. Exceptions and exclusions. Some canceled or forgiven debts may be eliminated from income by applying exceptions or reduced by applying exclusions to the general rule. This lists exceptions, and it states exceptions are applied before exclusions. Exceptions may allow the taxpayer to eliminate the following types of canceled debt from income: amounts otherwise excluded from income, certain student loans, deductible debt, and price reduced after purchase. It refers you to the publication 4681 for more information. There are several exclusions from the general rule for reporting canceled debt as income. In 1099-C is not a lot, as you won't see that a lot either. It is common for taxpayers to have debt canceled, and so you may see some 1099-Cs. I have not seen a lot of them in tax preparation. Discharge of qualified principal residence indebtedness is also something that's not common. Taxpayers may exclude from income certain debt forgiven or canceled on their principal residence. If the canceled debt qualifies for exclusion from gross income, the debtor may be required to reduce tax attributes by the amount excluded. Qualified principal residence indebtedness includes any debt incurred in acquiring, constructing, or substantially improving a principal residence that is secured by the principal residence, and any debt secured by the principal residence resulting from the refinancing of debt incurred to acquire, construct, or substantially improve a principal residence, but only to the extent that the amount of debt does not exceed the amount of the refinanced indebtedness. It advises you that the maximum amount that can be treated as qualified principal residence indebtedness for discharges after 2020 and through 2025 is $750,000. Is $375,000 in the case of a married individual filing a separate return. It gives you the criteria for canceled principal residence debt. It advises that you as a volunteer may assist taxpayers who meet the following requirements. The home was never used in a business or as rental property. The debt was not canceled because the taxpayer filed bankruptcy. The taxpayer is not in bankruptcy when he or she comes to the site for assistance. The Form 1099-C does not include an amount for interest. The debt must be a mortgage used only to buy, build, or substantially improve the taxpayer primary residence. The mortgage was secured by the taxpayer's primary residence, and the mortgage was not more than $750,000 or $375,000 in the case of a married individual filing a separate return. And I think I've only seen one case of this in all the years that I've been doing the VITA program. Any questions or concerns as it relates to anything that we've covered related to temporary provisions? No questions? All right, we're gonna hop right into filing basics. The objective of this lesson is to determine who must file a tax return and to determine who should file a tax return and how to verify the taxpayer's identity. All right. So who must file? U.S. citizens or residents of the United States must file a return based on 3 factors. There are special rules for dependents, surviving spouses, U.S. citizens, and residents living outside the U.S., residents of Puerto Rico, and individuals with income from U.S. territories. You want to always remember to use the interview techniques and tools when determining who must file. It's very important that you use your form 13614C in the stage of this to determine who must file. Sometimes taxpayers they come in knowing that they have a filing requirement. Sometimes they don't. In your publication 4012, there are charts that are available to you that will assist you in determining who must file, what type of income is taxable or non-taxable, and things of that nature, and that will help you to in order to make that decision if the taxpayer does not know. In order to decide whether someone must file a tax return, you will need to know the individual's age, their gross income, and what their filing status is. Now, if they don't know what their filing status is and you don't know, you can always, the inside of your software, there is an interactive tax assistant that can help you determine what their filing status should be. You will have to ask them some questions to go through their interactive tax assistance to determine what their filing status should be, or what filing status is going to give them the better advantage. On this page, it gives you a snapshot or a screenshot of what chart D looks like, and that chart D is for who should file, to determine who should file a return. Some instances are if the taxpayer had income tax withheld from their pay, pension, Social Security, or other income. Even if they don't meet the filing requirement, if they had any type of, if they had any type of income where they had taxes withheld, we still will advise them to file a return so that they are able to receive that money back that they had withheld from their pay, pension, Social Security, or whatever income it was. If you have a taxpayer that made estimated tax payments for the year, or they had any type of overpayment that they had applied, we encourage them to file a return to get that money back, things of that nature. If a taxpayer is required to file a state return, they are required to file a federal because they can't file their state without filing a federal first. The state information is pulled from the federal, so they are advised to file a tax return. And so it's all type of reasons why taxpayers have of why they should file a return, even if they think they don't have a filing requirement. Okay. It advises out of scope for this lesson is the health coverage tax credit. Verifying the taxpayer identity. We talked about this during the volunteer standards of conduct, as well as during the intake interview and quality review process. As the first step in the interview process, you should verify the identity of the taxpayer that you are dealing with. You want to verify their identity using a valid form of ID, as well as the Social Security number for them and any dependents that they are claiming. You want to also verify that the address and the spelling of their names are correct. And so I always call that the entity information. You want to always verify that entity information is correct, because that can result in the return being rejected, because the IRS pulls from the Social Security Administration. If that name does not match that Social Security card, the IRS will reject that return. If something is wrong with the address, and if they elected direct deposit and something is wrong with their direct deposit information, and the IRS flips their direct deposit to a check, is going to mail to whatever address was on that return. And if that address is not right, then they'll have issues getting their refund. So we want to always make sure that we are verifying that information. You can always use a valid driver's license, a passport, school ID, employer ID. You want to make sure that you're verifying their identity with some sort of picture ID. And if you're not sure what your site takes, you want to verify that information with your site or assistant site coordinator. Judgment should always be used in what type of identification you are using in order to verify that identity of that taxpayer. Exceptions to requiring photo ID should only be made under extreme circumstances and should only be approved by the coordinator. You should not be taking a work ID that expired last year or 2 years ago without first running it by your site coordinator. There are some exceptions if that person is known to the site, if the site coordinator knows that person because they've been coming to the site for years, they can sometimes make an exception to taking an expired ID or something to that nature. But before you do anything like that, you want to always talk to your site coordinator. Verifying the taxpayer information and their ID helps to protect against identity theft. We want to always remind taxpayers that correct information is necessary for them to receive age-related tax benefits. Another thing that we want to always be verify is taxpayer identification numbers. That can be Social Security numbers, individual taxpayers identification numbers or ITINs, and the adoption taxpayer identification number, which is ATINs. Again, you want to verify with your site coordinator or assistant site coordinator what their process or procedures are for verifying those types of numbers. Some will only verify using the Social Security number card, or some will use prior year returns or documents from the Social Security Administration. But you want to always verify that you are using what the procedures are of that site and not just basing it off what the taxpayer states, because that information could be incorrect. Out of scope for this lesson is taxpayers who cannot substantiate their identity. If they can, you've went through all the scenarios, you've given them every option that you can give them, and they are not able to verify their identity with you, you cannot assist them. they need to get something to verify their identity and come back, or you need to refer them to another place. Choosing the appropriate schedules. Form 1040 allows many taxpayers to file a short, simple form. The Form 1040 SR is a U.S. income tax return for seniors, and that form is also available. All forms are available in print and electronic version. You can go to irs.gov to get those. The Form 1040 SR may be used by taxpayers who are age 65 or older at the end of the tax year. Schedules 1 through 3 have been created for instances where additional information needs to be carried over to the face of the Form 1040 or the 1040 SR. The schedules are Schedule 1 that captures additional income and adjustments to income. Schedule 2 captures any additional taxes. Schedule 3 captures additional credits and payments. We will go through filing a return in the completing the return lesson. However, a return can be filed electronically using IRS e-file or by sending the return in by paper. Taxpayers choose how they want their return to be transmitted, whether they want it to be electronically filed, or most times when you have a taxpayer that owes a balance due to the IRS, they are going to choose to have that return mailed in, because the longer it takes for the IRS to get it, the longer it takes for them to collect it. Most taxpayers with a refund want it back as quick as possible, so they are going to elect to have that return e-filed. All right. IRS e-file is the safest, fastest, and easiest way to file a return. That free file for individuals with it is a free file option for individuals with income below the threshold. It's going to always refer you to your publication 4012 under Partner Resources tab for frequent taxpayer inquiries. If there are questions that the taxpayer have and you may not have the answer to it right off the top of your head, or no, you can go to the publication 4012 Partner Resources tab to get those answers. There's also an index in the publication 17, or you can go to filing requirements at irs.gov to find that information. Potential pitfalls that may happen or that you need to keep in mind. You want to always treat the information used to prepare an individual income tax return as confidential. You shouldn't be discussing what you saw on someone's return with anyone else. You can have general conversation. You should never be mentioning taxpayers' name or any type of PII information. Canadians have a number that is similar to a Social Security number, but it is for their Canadian old age pension. Do not use this number on a U.S. tax return. Canadians often have both a U.S. and a Canadian Social Security number. I have never seen a Canadian ID number unless it was one and I didn't know it was. But be mindful of that. Be alert to the following possible indications of fraudulent activity. A Form W-2 that is typed, handwritten, or has noticeable corrections. A Form W-2 that looks different from other Forms W-2 issued by the same company. A suspicious person occupying the taxpayer and observed on other occasions. Multiple refunds directed to the same address or PO box. Employment or earnings, which are a basis for refundable credits that are not well documented, and similar returns. Those are returns that have the same amount of refund or the same number of dependents or the same number of Form W-2s. Sometimes you will get returns that are similar. It's an easy return that only had 1 or 2 W-2s, and sometimes you get W-2s that or taxpayers that work for the same company or things of that nature, but you will notice after a certain amount of time if something starts to look redundant or similar, to you or something just does not feel right. And so anytime you have a situation like that, always take it to your site coordinator. Or as I mentioned on Saturday, if anything makes you feel uncomfortable, anything that's unusual, you always have the right to reject doing that tax return. Out of scope, again, is taxpayers who may qualify for the health coverage tax credit or credit for the repayment of previously taxed income, or taxpayers who you cannot substantiate their identity. Any questions or concerns about filing basics that we have covered? No? There are 3 charts located in the publication 4012. This lists 4, but it says 3. It says chart A is for most people who must file. Chart B is for children and other dependents. Chart C is for other situations when you must file. And chart D is for who should file. Individuals who are not required to file should file to claim a refund of withheld taxes or tax credit for which they qualify. And you want to, again, always ensure that you are verifying that taxpayer identity. Any questions or concerns? Move right along. Filing status is the next lesson that we will discuss. The objective of this lesson is to determine the most beneficial filing status that is allowed for the taxpayer. This lesson will help you determine the most advantageous and allowable filing status for the taxpayer. Selecting and entering the correct filing status is a critical component of completing the taxpayer's return. Again, if the taxpayer is unaware of what filing status they should use, and you are unsure of what that filing status should be, there is a filing status tab in your publication 4012. There's a decision tree there that you can use. There's also an interactive assistant built into the software that will help you determine what that filing status should be, or what the most the beneficial filing status for that taxpayer is. All right. The filing status impacts the calculation of income tax, the amount of the standard deduction, and the allowance or limitation of certain credits and deductions. There are 5 filing statuses. Taxpayers must use one of the 5 filing statuses. Filing status impacts, again, the calculation of the income tax, the amount of the standard deduction, and it determines what credits and deductions the taxpayer is allowed. The 5 filing statuses are married filing joint, qualifying surviving spouse, head of household, single, and married filing separate. Who is considered single?
Hey, ma'am, do you have those 5 statuses on a sheet somewhere?
Yes, you can find that information in the publication 4491.
Thank
Let's see. And so, and they're listed here. But if you go to, let's see. So what I am using, along with these PowerPoints is your publication 4491. And so if you go to irs.gov, the publication 4491 is there. And so that information is available. All the information that I'm using is in that publication 4491. And so your 4491 will show you all of, will give you a more in-depth, give you more in-depth information as it relates to the information that we're covering tonight. The PowerPoints won't go that far in depth as the 4491. And so I do use both to give you a little bit more information. Any other questions? So, who is considered single? Taxpayers can use a single filing status if on the last day of the tax year they were not married, legally separated or divorced, or widowed before the beginning of the tax year and did not marry. Again, in your publication 4012, there is a filing status decisions tree that you will be able to, you'll have to ask the taxpayer questions. Did you and your spouse live together? When did you separate? Were you divorced? When did you divorce? Things like that. And you have to go follow the errors, yes, no, to determine that. Or the better option is to use the interactive tax assistant. Either one is going to help you to make a decision on what filing status a taxpayer should use. Filing single may qualify for more beneficial tax status. Now, some single taxpayers can qualify for another status. Some single taxpayers could qualify for head of household or for the qualifying surviving spouse status, which can mean a lower tax. And so it just depends on what that taxpayer's situation is. Married filing joint is another filing status. This filing status is generally the most beneficial for couples. Married taxpayers who choose to file a joint return will use one return to report their combined income and to deduct combined allowable expenses. Married taxpayers can select this status even if one of the spouses did not have any income or any deductions. The married filing joint status can be claimed by taxpayers who, on the last day of the tax year, were married and lived together. They were married and living apart, but were not legally separated under a divorce or separate maintenance decree. State law governs whether taxpayers are married or legally separated under a divorce or separate maintenance decree. It could also be if common law marriage is allowable in the state or is recognized in that state. And so you'll have to know whether or not common law marriage is recognized in the state the taxpayer is in, and the state that they can't, if they moved from a common law state to another state, you'll have to know whether or not it is a recognized common law marriage. Tennessee does not recognize common law marriage, and so you'll have to be mindful of that. Or if they are the surviving spouse who did not remarry before the end of the tax year. A surviving taxpayer can file a joint return with the deceased spouse. All right.
So is it a time frame on that when they file with a deceased spouse, like a year or 2 years within at the end of the year? That's what you're saying?
For married filing joint.
No, surviving spouse.
Oh, surviving spouse is 2. It's 2 years.
Oh.
So, but surviving spouse has to have a dependent. And so we will talk about that. But in order for a taxpayer to file as a surviving spouse status, they have to have a dependent. But in order for us, so if you were married and your spouse died within the tax year, then you're still able to file married filing joint for that year. So say for instance, God forbid your husband or wife died in 2024, then in some part of 2024, then for this year, you're still able to file married filing joint because that your spouse died in the year. 2025, you may be able to file as a qualifying widow or widower if you have a dependent and if you did not remarry. Did that answer your question?
Yes.
Okay. Married filing separate is another filing status. The married filing separately status is for taxpayers who are married and either choose to file separate returns or cannot agree to file a joint return. Taxpayers who file as married filing separately each report their own income and deductions on separate returns. These rules do not apply in community property states. Some married taxpayers may be considered unmarried even if they are not divorced or legally separated. Such taxpayers may be able to use the head of household filing status, which may result in a lower tax than married filing separate. There is in your 4012, you can refer to a topic that says, can married taxpayers ever file as head of household? Or again, I would refer you to your interactive tax assistance or assistant or your publication 17 to determine if they are able to file that status. Taxes are generally higher for married filing separate, for the married filing separate filing status, because taxpayers are not allowed certain credits, or some credits are reduced under the married filing separate filing status. Taxpayers cannot take the child independent care credit, education credits, and certain other benefits and credits. Some credits and deductions, such as the child tax credit and retirement savings contribution credits, are reduced at income levels that are half those for a joint return. Also, a lot of taxpayers don't realize that if we are married filing separate, if the husband files his return and he files as separate and he itemizes, the wife also has to file as separate and she also has to itemize, even if she does not have enough to itemize. And so anytime someone comes in and they advise that they want to file married filing separate, I always ask the question, is the spouse filing married filing separate? And have they already filed their return and filed married filing separate, and or are they itemizing? Because if so, then that make you have, or makes that spouse or have a requirement to itemize as well. All right. In the case of married filing separate, a lot of couples, husband and wives, or whatever that looks like, they file married filing separate because one spouse may have a debt and the other spouse does not want to be liable for it or responsible for it. And so they feel like it's better for them to file separate returns than me being responsible for a debt that is not mine. And so you can always advise them that the form 8379, if you know about the form 8379 and injured spouse, you can advise them that they can still file married filing joint and file an injured spouse allocation. So that way they don't have to file married filing separate and lose the benefits of some of the credits that they may be allowed. That information, it refers you to the publication 17. A lot of times, if a taxpayer is coming in and they want or need the injured spouse form added to their return, they are already aware of that form and they will make you aware of it. And all you have to do is to add that to that return in the software. Head of household. This is the filing status that you will see the most during your volunteer time during the tax season. Taxpayers may qualify for the head of household filing status if they are unmarried or considered unmarried on the last day of the tax year, and they pay more than half the cost of keeping up a home for the required period of time, and they had a qualified person living in their home for more than half the year, except for temporary absences such as school. A qualifying person who is a taxpayer's dependent parent does not have to live with the taxpayer. However, the parent must qualify as a taxpayer's dependent for the taxpayer to qualify as head of household without using the multiple support provision. It refers you to the publication 4012, your volunteer resource guide, tab B, to determine who is a qualifying person for head of household status. The cost of keeping up a home include expenses such as rent, mortgage interest, real estate taxes, insurance on the home, repairs, utilities, and food eaten in the home. Under proposed regulations, a taxpayer may treat a home's fair market rental value as a cost of maintaining a household instead of the sum of payments for mortgage interest, property taxes, and insurance. It refers you to publication 17 for more information. Considered unmarried for head of household. Some married taxpayers may be considered unmarried for head of household status if they file a return separate from their spouse, pay more than half the cost of keeping up their home, lived apart from their spouse during the entire last 6 months of the tax year. The spouse is considered to have lived in the home even if temporary absence due to special circumstances such as military service or education. And they provided the main home for more than half the year of a dependent child, stepchild, or foster child placed by an authorized agency. All right. Can you all hear me now?
Yes.
Yes, we can hear you.
Qualifying surviving spouse. This filing status is as beneficial as married filing joint. It gives the same benefits as married filing joint for a taxpayer. So taxpayers who do not remarry in the year their spouse dies can file jointly with the deceased spouse, excuse me. For the 2 years following the year of death, the surviving spouse may be able to use a qualifying surviving spouse filing status. In order for them to qualify, the taxpayer must be entitled to file a joint return for the year the spouse died, regardless of whether the taxpayer actually filed a joint return that year. Have a child, stepchild, or adopted child who qualifies as a taxpayer dependent for the year, or would qualify as a taxpayer dependent except that he or she does not meet the gross income test or does not meet the joint return test, or accept that the taxpayer may be claimed as a dependent of another taxpayer. Live with this child in the taxpayer's home all year except for temporary absences, and have paid more than half the cost of keeping up the home for the year. It refers you to publication 4012 for more information on the dependency qualifications that apply to the child. Any questions or concerns as it relates to filing statuses? Again, there are 5. Taxpayers can either file single, married filing jointly, married filing separately, head of household, or qualifying surviving spouse. They always want to take the filing status that is going to give them the better benefit that results in the lowest tax. Filing status selection does impact the amount of tax credits and deductions. And so we want to always ensure that we are giving them the one that benefits them the most.
Oops, I have a question. So the status for a surviving qualified spouse, they do have to have a dependent in order to file that status, correct?
Yes.
Okay. Thank you.
Any other questions?
What's the limit for dependent, a qualifying dependent? Like what age? They any age?
As long as they qualify as a dependent. And so we will go over dependents in a few lessons.
Okay.
But, so sometimes age does not matter as it relates to that dependent on certain circumstances. And so as long as that person or child or whoever it is qualifies as your dependent. And so you want to always refer to either your publication 17 or your publication 4012 to determine whether or not that person qualifies as your dependent.
Thank you.
For the qualifying surviving spouse, it says they have to have a child, stepchild, or adopted child who qualifies as a taxpayer's dependent. And so it does not say as an age, but they would have to qualify as the taxpayer's dependent. And so it is the child for dependents. That can vary depending on what the qualification is on the return, but as qualifying surviving spouse, it must be a child, stepchild, or adopted, something along that nature. And so we'll get more into dependents in a later lesson. Any other questions? Personal exemptions is a super short lesson. And so the objective is to, you should be able to distinguish between a personal and dependency exemption, determine if a taxpayer can be claimed as a dependent on another taxpayer's return. So an exemption is a dollar amount that can be deducted from an individual's total income, thereby reducing the taxable income. Exemptions were suspended or reduced to zero by the Tax Cuts and Job Acts. And that began in 2018 and that goes through 2025. Although the exemption amount is zero, the ability to claim an exemption may make taxpayers eligible for other tax benefits. Okay. Personal exemptions generally allow taxpayers to claim themselves and possibly their spouse. Dependency exemptions allow taxpayers to claim qualifying dependents. The taxpayer and spouse can claim their personal exemptions only when the volunteer answers no to the intake question, can anyone else claim the taxpayer or spouse on their tax return? And so that question is asked on page 1 of the 13614C. Some people will answer their questions, some won't. And so you have to be mindful of that, especially when you have college or school age children that are coming in, filing those returns. If you have those taxpayers or that are in school, especially if they have they're getting education credit, we want to always be mindful to ask the question, can someone else claim you on a return, or has someone else claim you on a return? Because a lot of times they don't know. And sometimes, a lot of times, those returns are rejected because parents have already claimed those dependents. And so we want to be mindful of that. An individual is not a dependent of a person if that person is not required to file an income tax return and either does not file an income tax return or files an income tax return solely to claim a refund of estimated or withheld taxes. And so it refers to the publication 4012 Dependents tab that gives you an overview of the rules for claiming a dependent. There are tests that have to be met in order to be a qualifying child. And then there are additional tests in order to be a qualifying relative. And so if it's not your child, could be your nephew, your sister, your mom. And so they may qualify to be your relative versus your qualifying child. And so either or, there are tests that have to be passed or asked in order for that person to be a qualifying child or a qualifying relative. All right. When you're going through the entity portion of the 13614C and enter that information into TaxSlayer, it automatically populates that information on the 1040. And so if a person says that yes, someone can claim me or my spouse as a dependent, we want to ensure that information is checked, because if not, then it won't pick that information up on that 1040. And it will, whatever credits or deductions they are allowed for not being claimed as a dependent on someone else's return, they will be given. And so we want to always ensure that we are answering those questions correctly. Any questions or concerns as it relates to exemptions? personal or dependents. Dependents. And so identifying and determining the correct number of dependents is a critical component of completing the taxpayer's return. The deduction for personal and dependency exemptions is suspended for tax years 2018 through 2025, again, by the Tax Cuts and Jobs Act. Although taxpayers won't get the benefit of the exemption amount that was given before 2018, there are other credits or tax benefits that taxpayers can receive for claiming dependents. And so dependents are either a qualifying child or a qualifying relative of the taxpayer. The taxpayer's spouse cannot be claimed as a dependent. And so dependents can include a child, a stepchild, sibling, or parent. There are 3 tests that apply to both the qualifying child and qualifying relative. There is a dependent taxpayer, joint return, citizen, or resident. The bottom section of the intake and interview sheet addresses the issues concerning dependency, but you will still need to use your interview skills to clarify whether the individuals listed are eligible to be claimed as dependents. It refers you to your volunteer resource guide or your publication 4012, tab C, which is dependents, for guidance on asking probing questions to verify the information on the intake and interview sheet. And so on the 13614C, at the very bottom, it asks for taxpayers to list people that lived in their homes or whatever their verbiage is on the bottom of that form. Most times I would advise them to just list whoever they're claiming as a dependent. If they so happen to list everyone that's listed in their home, whoever is doing that intake interview is going to go through to determine whether or not that taxpayer is claiming all of those people that are listed on that form, and they will note whether or not they are or are not, so that you will know who they're claiming as a dependent by the time they get to you as a preparer. There are 5 additional tests for a qualifying child. It's the relationship, age, residency, support, and the qualifying child of more than one person. In your publication 4012, under your dependents tab, there is a table, table 1 for all dependents. And so it advises you of what to probe or ask the taxpayer as it relates to determine whether or not this person will qualify as a qualifying child. Qualifying relative test is sometimes it's a little similar to the qualifying child test, but for qualifying relative, they only have 4. And so they must not be a qualifying child. They have to be a member of the household or relationship, have a relationship with the taxpayer. It depends on what their gross is and whether or not you provided any type of support to them during the tax year. In publication 4012, under the dependents tab, there is table 2, gives you more information on qualifying relative dependents as well as a worksheet for determining support if the taxpayer is not able to determine whether or not this person qualifies as a qualifying relative, depending on if that person had income or not. And so that worksheet can be used to determine whether or not they would qualify as a qualifying relative for the taxpayer. Children of divorced or separated parents. There are special rules that apply to children of divorced or separated parents. In most cases, the child is the qualifying child of the custodial parent. However, a child will be treated as a qualifying child or qualifying relative of his or her non-custodial parent if all the following conditions apply. The parents are divorced or legally separated under divorce or separate maintenance decrees or written separation agreements, or lived apart at all times during the last 6 months of the year, whether or not they are or were married. The child received over half of his or her support for the year from the parents. The child was in the custody of one or both parents for more than half the year, or the custodial parent signed a written declaration, which is the Form 8332, or some sort of similar statement giving the other parent permission to claim that dependent.
I have
Any-
a question about that.
Mhm.
If they have joint custody, then who is the custodial parent then?
So a lot of times, especially if they are married and divorced and they have some sort of divorce decree, or if it was a custody agreement that went through the court, a lot of times they'll have in those decrees or in those court orders who can claim the dependent, what years. Sometimes the parents will determine who can file the child on what given year. Other times we won't know who the custodial parent is. You may see that a lot where tax returns are rejected because the mom came in and to file her return and it was rejected because the dad had already filed the child on their return, or the dad had permission to file the dependent and the mom had already and so you will have a lot of that. At that point, there's nothing that you can do about it. They have to mail their return in and give the Internal Revenue Service proof of who had the right to claim the dependent. And so we have no way of being able to determine who is the custodial parent and who is not, who had the right to claim the dependent, who did not. And so most times you are taking the word of that taxpayer. Whether or not it is true, we don't know until their return comes back either rejected or not. And so in your publication 4491, it advises that if the child lives with each parent for an equal number of nights during the year, the custodial parent is the parent with a higher gross income, higher adjusted gross income. And so if you have two parents in and they're trying to determine who is the custodial parent because we both have joint custody and we both had them an equal number of nights, then you can use that as a tiebreaker. If not, then I mean that's above your pay grade. Any other questions or concerns as it relates to dependents? A lot of times when taxpayers are coming in, they already know who they're claiming, why they're claiming. All of that is nothing for you to figure out. they're gonna tell you, I'm claiming A, B, C, and D. And so there's nothing else for you to do but to complete their return, especially if they have all the required documentation. They advise on that form 13614C, the dependent live with me all 12 months of the year. I have the social security card, it's my son, my daughter, all of that. And you have, it does not appear to be unusual or, you know, it makes you on any of that, then there is no way for you to know whether or not that information is true or not. So in summary, for taxpayers to claim a dependent, the following conditions must be met. The taxpayer may not claim a dependent if the taxpayer may be claimed as a dependent on another taxpayer's return. The taxpayer may not claim a dependent who files a joint return unless the joint return is filed only to claim a refund and no tax liability will exist for either spouse on separate returns. A person cannot be claimed as a dependent unless that person is a U.S. citizen, U.S. resident alien, U.S. national, or resident of Canada or Mexico for some part of the year. A dependent must either be a qualifying child or a qualifying relative. It is 7:33. Let's take a 15-minute break, and then we'll pick up on unique filing situations.
Yes.
All right.
Yes.
With unique filing situations. The objective of this lesson is to determine whether an individual is a resident or non-resident alien. Apply the support test and citizen or resident test to determine whether an individual can be claimed as a dependent. Apply special rules for head of household status when the spouse is a non-resident alien. I don't think I've ever had a situation dealing with this, but it may, you never know. This lesson will assist you in addressing some filing status issues you may encounter with helping taxpayers who are not U.S. citizens. This lesson also covers dependent issues related to taxpayers who may have non-resident alien stepchildren and that are children of a non-resident spouse who is married to a U.S. citizen or resident alien. This lesson does not cover the preparation of return for taxpayers who are in the U.S. on an F as in Frank, J as in Mary, J as in Jack, M as in Mary, or Q as in Queen visa. You want to refer those taxpayers with one of those visas to a volunteer who is certified to prepare tax returns for foreign students or to a professional tax preparer. Non-resident aliens are taxed differently from resident aliens. It refers you to the chart in your publication 4012, resident or non-resident alien decision chart for any questions. Non-resident aliens can include students, teachers, trainees, or undocumented immigrants. Your role is to determine if the non-resident alien can be treated as a resident alien for tax purposes. Most tax rules that apply to a U.S. citizen will also apply to the resident alien, including filing status and dependent issues. In order to determine if the taxpayer is a resident alien or a non-resident alien, you should look at your intake and interview sheet. There is a question on that form where taxpayers and their spouses can indicate whether or not they are U.S. citizens. And another part of that form Taxpayers can indicate their citizenship or residency of family members and dependents. If the taxpayer has checked no for U.S. citizen on the intake and interview sheet, you must determine if the person can be treated as a resident alien for tax purposes before continuing. An individual must meet one of the following tests to be considered a resident alien for tax purposes: the green card test, or the substantial presence test. The green card test, individuals who were lawful permanent residents of the U.S. at any time during the tax year are resident aliens. They were given the privilege, according to immigration laws, of residing permanently in the U.S. They receive alien registration cards, commonly known as green cards, attesting to this status. Green cards are approximately the same size as driver licenses. They are no longer green in color, but still hold the name. Most green card holders have valid Social Security numbers and must follow the same tax laws as U.S. citizens, including the requirement to report worldwide income on their tax returns. The substantial presence test. This test is based on a formula of days and years a person is physically present in the United States. Individuals who do not have green cards may still be considered resident aliens if they meet the requirements of the substantial presence test for the calendar year. They must be physically present in the U.S. at least 31 days during the current year and 183 days during the 3-year period that concludes the current year and the 2 years immediately before, counting all days in the current year, 1/3 of days in the previous year, 1/6 of days in second year before current year. An individual who meets these requirements is, for tax purposes, a resident alien. Again, this is something I have not seen or something that is common in the VITA TCE sites. If you so happen to get something like this and you are not familiar or not certified, then you need to refer this to your site coordinator or refer them to a paid professional. A non-resident alien spouse is a U.S. citizen or resident alien who is married to a non-resident alien spouse who does not meet either the green card or substantial presence test, and they generally have 3 filing status options. The taxpayer may choose to file as married filing separately. The couple may choose to file as married filing joint. There's only 2. Okay. The taxpayer may qualify for head of household under the regular rules for a married person who is considered unmarried, even while living with a non-resident alien spouse. Taxpayers must declare in writing that they are choosing to treat a non-resident alien spouse as a resident alien on a joint return. The taxpayer may qualify for head of household under the regular rules, even while living with a non-resident alien spouse. There is an exception that allows taxpayers who live with their non-resident alien spouses to file as head of household. All of the following requirements must be met. The taxpayer is a U.S. citizen or resident alien for the entire year and meets all the considered unmarried rules for head of household, except for living with a non-resident alien spouse. The non-resident alien spouse chooses not to file a joint return. The taxpayer must have a qualifying person to be eligible for this filing status. The spouse is not a qualifying person for head of household. It refers you to the interview tips in publication 4012 under starting a return and filing status tab for more information and to see if the citizen's spouse qualifies to file as head of household. The test for dependents and qualifying relative or qualifying child apply in the same way to citizens or resident aliens. There may be unique issues with the support test and the citizen/resident test. It refers you to the publication 17 in chapter 3 or the interactive tax assistance, which is to determine who may I claim as a dependent. Your software is going to be very useful in assisting you with answering certain questions you may not have the answer to, like who can I claim as a dependent, what is the best filing status, things of that nature. All of that is built into the software so that you don't have to find all of that out for yourself. There are special rules for children born overseas and for adopted children. Out of scope, as I stated at the beginning of the lesson, if a taxpayer has visas with F, J, M, or Q, then that is out of scope for the VITA TCE program, unless someone is qualified with the foreign student certification. Non-resident aliens who do not meet the green card or substantial presence test and are not married to a U.S. citizen or resident alien, and individuals having a dual status for the tax year. Any questions or concerns as it relates to unique filing situations? No. Income is the next lesson that we will cover. This is the first of 9 lessons that we will go over that will cover the income section of a taxpayer's return. On the front, or what you are seeing now, is the front or the top part of a Form 1040 that shows where most of the income, or shows where the income is listed on or pulled from those documents that you are going to input into the tax software. A critical component of completing the taxpayer's return is distinguishing between taxable and non-taxable income and knowing where to report the different types of income on the 1040. At the end of this lesson, you should be able to, or will be able to, distinguish between what is taxable and what is non-taxable income, distinguish between earned and unearned income, and know how to report that income correctly on your form, on the Form 1040. In your publication 4012, under the income tab, there is a income quick reference guide that gives you a quick reference to what is considered taxable income. And then there's another part at the bottom that gives you examples of non-taxable income. So sometimes you will have individuals that come in and they're not sure if the income document that they received, if that income is taxable or non-taxable. And so you can refer to your publication 4012 under tab D to determine whether or not that income is taxable or non-taxable. Gross income is all income received in the form of money, goods, property, and services that is not exempt from tax. It includes income from sources outside the U.S. or from the sale of a primary residence, even if part or all of that income can be excluded. Gross income may include part of Social Security benefits received and certain scholarships and fellowship grants. Income that is taxable must be reported on a taxpayer return and is subject to tax. Income that is non-taxable may have to be shown on a taxpayer return but is exempt from tax. Form 1040 and its associated schedules are used to report earned and unearned taxable income. Earned income is any income received for work, such as wages or business self-employed income. Wages is normally reported on a Form W-2. Business or self-employed income is normally reported on a 1099. That can be a 1099 miscellaneous, 1099-Q, 1099-K, or if a taxpayer is self-employed, they could have documentation of cash received in their business. Unearned income is any income not earned from work, such as unemployment income or income produced by investments such as interest on savings, dividends on stock, or rental income. Some non-taxable income, such as gifts and inheritance, are excludable and not shown on the return. It refers you to publication 4012 using TaxSlayer Pro Online tab, navigating TaxSlayer chart. Again, a lot of your income documents will include forms such as a W-2, a 1099 INT, a 1099 DIV, or 1099-G. You want to always probe your taxpayers to determine all sources of income to ensure that they are reporting all type of incomes, whether or not they know whether that income is taxable or non-taxable. Encourage them to give it all to the intake person or the preparer, and let them use their chart or the publication 17 or whatever information resources they have to determine whether or not that income should be included on their return. The Form W-2. Employers must report wages and other employee compensation on Form W-2. Employers are not required to mail Form W-2, but they must make them available to employees by January 31st. Employees may need to pick up Form W-2 from their employers or obtain it electronically. Most employers issue a standardized version of Form W-2, which is the wage and tax statement. If you need to see what a Form W-2 look like, you can go to irs.gov to view one. On the screen is a snapshot of what a Form W-2 can look like. Box 1 is the box that will have wages, tips, and other compensation that a taxpayer has earned over that tax year. If a taxpayer does not receive their Form W-2 by January 31st, we always advise them to first contact their employer to find out if and when that form has been mailed, or if they can access it online, if they can pick it up. I would not advise for them to contact the Internal Revenue Service. The Internal Revenue Service normally does not receive wage and income documents until around June of that year. There is a form that taxpayers are able to complete if they have not received their Form W-2, and it's a Form 4852, which is a substitute for Form W-2, wage and tax statement. If they have not received their W-2 in time to file their return. Household employees earning less than $2,200 may not receive a Form W-2, but the income must be reported. Self-employed taxpayers who receive tips should include their tips and gross receipts on Schedule C. It advises you that there is a YouTube video on if the W-2 is missing. Again, there's information in your publication 4012, your publication 17, or you can go to irs.gov for more information on what a taxpayer should do if they are missing their Form W-2. Scholarship and fellowship income. Scholarships and fellowships may be fully or partially taxable or non-taxable. Taxable amounts include payment for services, money used for personal living expenses such as room and board. If the taxpayer received Form W-2 for the scholarship or fellowship, it is considered earned income. Include the amount on Form 1040 as wages, just as you would any other Form W-2. I have not seen a W-2 that was taxpayer received as because of a scholarship or any type of fellowship. It can happen. It could happen. I have not received one. If you so happen to receive one, you can refer to publication 4012, Education Benefits tab, for more information on how to treat a scholarship, tax treatment of scholarship and fellowship payments. Interest income. Common sources of taxable interest income are checking and savings accounts, certificates of deposit or CDs, savings certificates, U.S. government bonds, interest on insurance proceeds, and loans that the taxpayer makes to others. Some savings and loans, credit unions, and banks call their distributions dividends. These distributions are really interest and are reported correctly as interest on Form 1099 INT. If a taxpayer has a form, has interest or is used to reporting interest on their return, they're going to have those documents. Sometimes if the interest is not that much, a banking institution won't send a Form 1099 INT. A lot of taxpayers will go to their banking institutions, go online to their accounts and get the amount of interest they have received or paid or whatever that looks like over the tax year, and they'll just bring that amount into you even without a Form 1099 INT, and you can include that on the return. Dividends. Dividends are reported to taxpayer on the Form 1099 DIV. There are ordinary dividends, Section 199A dividends, and qualified dividends, which are eligible for lower tax rates. Ordinary dividends are corporate distributions paid out of the earnings and profits of a corporation. Any dividend received on a common or preferred stock is an ordinary dividend unless the paying corporation states otherwise. Ordinary dividends are reported on the Form 1099 DIV. It refers you to the publication 4012 income tab for dividend income, or you can see the publication 17 dividends and other distributions for more details. Dividends are generally all dividend incomes reported on Form 1040 lines 3A and 3B. Qualified dividends and ordinary dividends. You don't see this a lot. You will see this some, but it's not a whole lot. Taxpayers will come in with their documentation if they have any type of, if they paid any type of dividends, and they will have their documentation in order for you. Capital gain distributions will appear on Form 1040, and it will go to its respective lines once you've entered it in the correct place in the software. You're going to ask the taxpayer for their annual brokerage statement if they did not receive a Form 1099 DIV for a dividend. If a taxpayer has dividends, know anything about a dividend, they already know what documentation they need. And they have the documentation with them. A Schedule B is needed if the taxpayer's ordinary dividends are greater than 1,500. You won't have to determine whether or not a Schedule B is needed. The software does all the calculation and computation for you and complete the necessary schedules as it relates to based on the information that you are entering. Out of scope is Form 1099 DIV with boxes labeled unrecapped Section 1250 gain, Section 1202 gain, cash liquidation distributions, and non-cash liquid distributions. State and local refunds. taxpayers receive a Form 1099-G, if they receive state and local refunds, they will have that with them if they have received a state or local refund, because most times they won't know what that 1099-G is for. But taxpayers who receive a refund of state or local income taxes will receive or may receive a Form 1099-G reporting their refund amounts. Only taxpayers who itemized and received a federal income tax benefit for deducting their state or local income taxes have to include their state and local tax refund in incomes. Not everyone must include the refund in their taxable income. Taxpayers who claim the standard deduction on the tax return for the year they received a refund of state or local income taxes do not have to include the refund in their taxable income. Taxpayers who itemized and deducted the state sales tax instead of the state income tax withheld or paid do not have to include the refund in their taxable income. And so anytime a taxpayer has the Form 1099-G for a state or local refund, then you need to ask the question if they itemized last year. If they did not itemize, that 1099-G is not included. If they itemized and they took sales tax and not state income tax, you still don't include it. And so you'll just have to, you'll have to know whether or not you need to include that on the return. Taxable refund, if it is taxable to that taxpayer because they did not claim the standard deduction, or they did itemize and they claim the state income tax, then it will report on 1040 on the Schedule 1. Alimony is not something that is common as well in the VITA TCE site. Alimony is a payment to or for a spouse or former spouse under a separation or divorce instrument. Do not confuse child support payments with alimony. If a taxpayer comes in and state that they have alimony, then you will need to ask the taxpayer if they have a post-1984 and pre-2019 divorce or a post-2018 divorce. And so you report alimony on Form 1040 Schedule 1 if the taxpayer is receiving alimony. If they are paying alimony, then it's reported on Schedule 1, Adjustments to Income section. For any divorce or separation instrument executed after December 31st, 2018, or modified after that date, alimony and separate maintenance payments are not deductible by the payer spouse and are not included in income by the recipient of the payments. Any questions as it relates to alimony? On page 2, under income, on Form 13614C, the taxpayer is going to list whether or not they have alimony, and the intake or interview person is going to clarify what they mean by alimony. It refers you to publication 4012 under the adjustments tab for alimony requirements. Any questions or concerns as it relates to this lesson?
Okay, I have a question. Can you tell me what you just said about the one that the payer do not claim it, and the one that receive it don't report it as income? Is that what you said?
No, so if they're paying or receiving, it's reported in 2 different places. So if the taxpayer that you have sitting across from you is receiving alimony, then it shows on their Form 1040 Schedule 1. If the taxpayer sitting across from you is paying alimony, then it's reported on their Schedule 1 under adjustments to income.
Okay, thanks.
Yeah, and you're welcome. And so this alimony is not something that is common. You won't. I don't think I've ever seen alimony, and so it's not coming. And if you do see it and you have any questions regarding the alimony, where it should be, if you should be accepting that, go to your site coordinator or a more experienced volunteer, or pull out your publication 4012, or go to your publication 17 to determine whether or not the alimony should be included on that return. All right.
I have a question.
Mhm.
Going back to where you were on the interest income and you said some of the taxpayers can go get the information
Mhm.
from their institution, do we just take their word on how much they have, or does it need to be printed from the bank or institution?
No, so they can tell you what I mean, they're including it as taxable income. And so it's not like they're getting an adjustment or anything for it. It's actually a taxable income. And so if they're telling, because depending on what that amount is, if it was $10 or less, the bank or credit union is not going to send an interest statement. Sometimes if it's a little higher, $18 or something, they may not send a statement. And so the taxpayer may have went to the banking institution and asked, how much interest did I receive, or how much interest has been paid, or whatever that looks like, and the bank will let them know, or they'll pull their records and it'll show $10, $12, or whatever that looks like. And so they'll tell you, I had $12 worth of interest at the bank, or whatever that looks like. And so
Okay. I wouldn't even go through that problem, but I guess, hey, they want to be the most accurate they can be, huh?
and you have some that want to include every dollar that's considered earned and taxable income. And so you have some that would just say, hey, I had $10 worth of interest. Okay, what bank was it? And so I just enter it. You're going to enter it under interest income.
Okay.
Any
Thanks.
other questions or concerns? All right, we're gonna move right along to business income. Business income is one that may be one that you see, because you have a lot of taxpayers that do receive the 1099 miscellaneous, the 1099 NECs, the 1099Ks, 1099Qs for different type of businesses. And so this may be a common occurrence that you will see. And so this lesson will help you prepare an accurate return for taxpayers who have business income, including self-employment income. Form 1040 is used to report income from a business or profession operated as a sole proprietor or independent contractor. Preparation of tax returns with Schedule C, profit or loss from business, which is a sole proprietorship, are in scope for VITA TCE under certain limited conditions and with expenses of $35,000 or less. This lesson covers record-keeping requirements for taxpayers with business income and expenses. It refers you to the publication 334, which is a tax guide for small business, and publication 583, which is starting a business and keeping records, for more information. At the end of this lesson, you will be able to determine how to report business income, determine what business expenses are within the scope of the VITA TCE program, identify some red flags when preparing a Schedule C return, especially when you see taxpayers filing a Schedule C for earned income credit purposes, and determine what records should be maintained. So anytime you have a taxpayer coming in and they are reporting business income or a business loss, you want to always ask probing questions to determine if the taxpayer or spouse had business income, or if they are self-employed. Business income information may come from a Form 1099 miscellaneous. And a lot of times you will see a Form 1099 NEC now, which is non-employee compensation. You have some that may receive a Form W-2 as a statutory employee. That's not common, but you may. And if they have the Form W-2, then it's going to be in box 13, statutory employee is going to be checked. Some employees will have the Form 1099-K, and those 1099-Ks come from payment card and third-party network transactions. Others they just may have their records, and so you will have some taxpayers that operate with for themselves, and they receive cash and things like that, or they may have a combination of all. The 1099 NEC, they may have some 1099-Ks, and they may have their records to say, I received $3,000 in cash, or whatever that looks like for the year. And so you'll take all of that information to compile it to determine what their business income is. Based on your interview and the completion of the taxpayer's intake and interview sheet, you may discover that the taxpayer or spouse had business income from being self-employed or working as an independent contractor. Taxpayers are self-employed if they carry on an unincorporated trade or business as a sole proprietor or independent contractor. These taxpayers may have income statements for their business income and expenses. The information to prepare their tax return comes from their records. You want to carefully review the intake and interview sheet and ask follow-up questions to determine if the taxpayer or spouse had business income. Taxpayers may not think of themselves as self-employed if they have a small home business or work part-time as an independent contractor. Cash payments or cash income. Some taxpayers may indicate that they received cash income for self-employment activity. This income must be reported unless it is excluded by law. If the taxpayers do not have adequate records of the cash income they received, you may be able to assist them with simple record reconstruction. Most times, the taxpayers are going to have that information already. Some will have a ledger or have it wrote out for you and already have it totaled, and you won't have to do anything but include that total amount of cash received on their Schedule C. Qualified Medicaid waiver payments are treated as difficulty of care payments and excludable from gross income.
Excuse me.
Mm-hmm.
I have never did a qualified Medicare payment. How does that work, and how does it look?
It's not common as it's something that's not common as well. And a lot of times, it's not. It could be. It may not be taxable to the taxpayer, but if they have qualified Medicare waiver payments, then they'll have the documentation for it. And
Okay, and that means that they have paid so much into Medicare.
No, the qualified Medicaid waiver payments. No, and so I think we have a lesson on qualified Medicaid waiver payments. If not,
yes, ma'am.
then I'll give you more information on it.
Okay, because I'm and I when we get into self-employment, because I have another question to ask too. But okay, thank you.
I'll write that down. So I'll give you more information on the qualified Medicaid waiver payments.
Yeah, Medicaid and Medicaid and Medicare are two different programs.
You also mentioned the ledger. Are we taking the ledgers from them as well, or are they keeping those?
They keep it, and so you're just verifying the amount.
Okay.
And so I'll come back to the qualified Medicare waiver payments and give you more information on that. I think it may be covered in a different lesson. If not, I'll go back. I'll pull some more information as it relates to qualified Medicare waiver payments. And so, and in your publication 4491, they do have a little bit of information as it relates to qualified Medicaid waiver payments. And so sometimes, a lot of times, those payments are excluded from gross income. And what those payments are is, if someone is a caregiver or a patient receiving caregiver benefits, that person receive qualified Medicaid waiver payments. And so that's how it is determined whether or not those payments are excluded or not. And so to be qualified Medicare waiver payments, the care provider and the care recipient must reside in the same home. When the care provider and the care recipient do not live together in the same home, the Medicaid waiver payments are fully taxable. And so it really comes into play when you're talking about the when you're dealing with different credits and things of that nature. But a lot of times that Medicare waiver payment they are excluded from gross income. In your publication 4012 under tab D, there is information on when or how to enter the Medicaid waiver payments. And so I will still find some additional information as it relates to Medicaid waiver payments. But again, it's not something common that you will see as it relates to the returns. Any other questions or concerns?
Okay, if you have somebody that come and they what kind of W-2 would they have for that? They would just have something that's written down.
For the qualified Medicaid waiver payments?
Yes.
No, they would have some sort of documentation. If they received those payments, then they're going to have some documentation. Hold on 1 second. Okay, so in your publication 4012, under tab D, it advises you on how to enter Medicaid waiver payments. And so it advises you that qualified Medicaid waiver payments are reported on Form W-2 in box 1. And so you're going to enter that Form W-2 in the software just like you would any other W-2. And so it advises you that a taxpayer may not choose to include or exclude only a portion of the qualified Medicare waiver payments. Some will want that included as earned income so that they qualify for the earned income credit or the additional child tax credit. Some may not want it to be included as taxable income because it may make their income so you can go to your publication 4012 to determine whether or not it should be included, if it should be included, how you enter that into the software. All right. So business income is reported on on Schedule C. And so when you go into your software, it's going to ask you when you enter the 1099 NEC, the 1099K, 1099 miscellaneous, or whatever you're entering with that income, it's going to ask you, do you want to report that to a Schedule C? And so if the taxpayer had a business, then yes, you're going to report that business income to a Schedule C so that you can show income and expenses for that business. The only time Schedule C is in scope for VITA TCE, the taxpayer had less than 35,000 in business expenses. They used the cash method of accounting. They had no inventory at any time during the year. They did not have a net loss from the business. They have no employees during the year or paid contract labor for services. They are not required to file a Form 4562, which is depreciation and amortization for the business. They do not deduct expenses for business use of a home. They also do not have prior year unallowed passive activity losses from the business. Now, more than one Schedule C can be prepared if the taxpayers have more than one business or to report each spouse's share of the business if it is jointly operated and filing a joint return. You want to always ensure that you are clarifying the taxpayer's business income and their expenses. As a IRS certified volunteer, you must exercise due diligence when preparing tax return. That means that you are doing your part to ensure the tax return is correct. So you want to ensure that you are doing your part when preparing or reviewing the tax return to ensure the information on the return is correct and complete. Generally, you can rely in good faith on information from a taxpayer without requiring documentation for verification purposes. However, when you are preparing a return with a Schedule C and the earned income tax credit, take additional steps to determine that the net self-employment income used to calculate the amount of or eligibility for the earned income credit is correct and complete. You want to ensure that you are asking sufficient questions of the taxpayers that are claiming the self-employed income to be satisfied that the taxpayer actually conducts a business, the taxpayer has records to support income and expenses, or can reasonably reconstruct income and expense records. All income and related expenses have been included on the taxpayer's Schedule C. You want to emphasize to the taxpayers that in the event of an IRS audit, they will need to provide those receipts in order to support their reported income and expenses. Now, there are certain situations involving the Schedule C and the EIC that should raise red flags. If some examples of what to watch for when a Schedule C should raise a red flag, is if the Schedule C income is reported in round numbers. Now, for me, I don't, sometimes a taxpayer, especially if they've already computed the information or calculated the information for you, sometimes a taxpayer will round up. I don't see the big deal in them giving you, instead of them giving you my cash income with $3,018.43. I just rounded it off 3,018 or 3,020 or whatever that looks like. Schedule C cash businesses as the only source of income on a return claiming EIC. Schedule C with little or no expenses when expenses would be expected. Or Schedule C taxpayers with little or no records for income and expenses. Again, if anything raises a red flag to you, you want to take it to your site coordinator. If something feels off regarding the information to the taxpayer, if it feels unusual or questionable, then you can question it, or you can refuse to do that return, and you can send them to someone else or to a paid professional. You don't have to complete that return. Business expenses must be ordinary and necessary to be deductible. In the Schedule C in the 1040 instructions can give you more information as it relates to that. You can refer to your publication 4012. Completing the Schedule C. The same business expenses are deductible on the Schedule C. If the taxpayer's Form W-2 has a statutory employee box checked, follow tax layer guidance for Schedule C. We went over, some out of scope situations. If expenses, exceed 35,000, then we know that is out of scope. If they have a net loss, then we know that is out of scope for the VITA TCE program. Business records should include a summary of business transactions and all supporting documents. It refers you to the publication 4012 tab D under income. It also advises you that some taxpayers may need to reconstruct records to support claimed business income and expenses. Out of scope. If their Schedule C is only for a hobby, or they have hobby income or not-for-profit activities, if their expenses go over 35,000, they do have return and allowances or cost of goods sold, which is inventory. They do have expenses for employees. They use their home for their business, and they're claiming that expense. If they have casualty losses to report, they have vehicle expenses reported as actual expenses. If they have contract labor, depreciation, if they had a vehicle lease expense of more than 30 days, if they'd use any method besides cash. So if they're using the accounting method that is out of scope, if their Schedule C results in a net loss. So if they had more expenses than they did income, and it results in a net loss, that's out of scope. If they answer no on line G, credit card payments are not includable in income, and they indicate yes, that they have a requirement to file Form 1099. That is out of scope for the VITA TCE program. Any questions or concerns?
So if it's out of scope, we would not do the return. Is that correct?
No, that's correct.
Okay. Thank you.
Excuse me. Person out of scope means that they do not have receipt information.
No, so
what?
anytime that we mentioned out of scope for the VITA TCE program, then
Mhm.
that means it does not meet the requirements for the VITA program. And so under VITA, if they are under the $67,000 threshold and they
Mhm.
come in to get the return done, but they have a Schedule C, but on their Schedule C, so they're under the $67,000 threshold, but they
Yes, ma'am.
have $40,000 worth of expenses. Then they're still out of scope for VITA because VITA only deals with $35,000 and under when it comes to expenses on a Schedule C.
And excuse me, most of that when they do that, this line. I'm sorry. Thank you.
Welcome. Any other questions or concerns? I think the last thing that we may be able to cover is capital gains or loss. And so this lesson will help you assist taxpayers who must use the Form 8949, sales and other dispositions of capital assets in conjunction with the Form 1040 Schedule D capital gain and losses to report capital gains and or losses on the sale of assets. This lesson includes topics on the sale of stock, mutual funds, and the sale of a personal residence. You will see this some. It's not very common. I have seen this where some people have sold stock, and so they do have the information needed in order to complete a Form 8949 or a Schedule D. And so the objective is to determine the adjusted basis of capital asset, determine if the asset's holding period is long-term or short-term, calculate the taxable gain or deductible loss from the sale of capital assets, determine whether a home is a taxpayer's main home, determine if a taxpayer meets the ownership and use test, and determine when the 5-year ownership use test period is suspended. And so in order for a taxpayer to report a capital gain and loss, they do use the Schedule D in the Form 8949. Again, that form, that schedule and that form is automatically populated in your software. Once you enter the information based on the income documents the taxpayer provides. In order to, the form, depending on to determine the capital gain or loss, you have to know the cost basis. The cost basis is the original purchase cost, and what the holding period is. And that holding period is the time between the date of purchase and the date of sale. All that information is normally included on the documentation that a lot of times it's a consolidated statement that the taxpayer will bring into you, and it has all of that information on it for you. And all you have to do is to enter that information into the system, and the system is going to pull that information and put it where it needs to be. It's going to have the cost basis, the holding period, the sales price, all of the information that's needed. If not, the taxpayer needs to provide that information for you. If they don't have it, then they need to get it for you, or you'll need to refer them to someone else. The basis of stock. In order to compute gain or loss on a sale, taxpayers must provide their basis in the sold property. The basis of property is usually its cost. If taxpayers need help determining their basis and do not have their original purchase documents, you want to refer them to publication 551 and their stockbroker. There's nothing for you to figure out. If taxpayers cannot provide their basis in the property, the IRS would deem it to be zero. Again, a lot of times if the taxpayer is bringing this information in, they have all the information you need in order for you to put this information into the system. There's nothing for you to go and figure out. If the taxpayer is bringing it in, this is something they're common or used to, and they have all the information you need in order to get it done. The adjusted basis. An adjustment to basis may include additional commissions or fees paid to the broker at the time of purchase or sale. Normally, you'll see this in stock. A lot of times when you see this type of document is normally some stocks that the taxpayer has sold. If taxpayers receive property as a gift or inheritance and do not know the basis, you want to refer them to a professional tax preparer. The holding period. That holding period is either going to be short-term or long-term. Short-term is 1 year or less and is taxed at a regular income tax rate. Long-term is more than 1 year and it's also taxed at a lower rate than short-term. Mutual fund shares are generally acquired at various times in various quantities and at various prices. So figuring the basis can be difficult. If the taxpayers don't know this information, you need to advise them to get it, or you need to refer them to a paid professional. Blocks of stock may have differing holding periods and basis. Unless specified at the time of the sale, blocks or shares are normally sold using the FIFO or first in, first out method. Proceeds from the sale. Brokers report information about the sale of stock on the Form 1099-B. If they have entries on a 1099-B in boxes 8 through 13, they are out of scope for the VITA TCE program. Unless securities sold were non-covered securities, brokers must report the cost or other basis and whether that gain or loss is short-term or long-term. If they don't know this information and can't provide this information for you, they need to get it for you, or you need to refer them to a paid preparer. TaxSlayer Schedule D, capital gain or loss screen, determines short or long-term gain and calculate gain or loss, tax liability, and capital loss carryover. Stock sales and other distributions may be reported by brokers on a 1099 consolidated statement or a substitute 1099. At the bottom of the screen, it shows you kind of a snapshot of what a consolidated statement may look like. But again, most taxpayers, if they're coming in and they are, and they have if they've sold stock, bought stock, or anything like that, then they're going to have all the information you need. You use the Form 8949 for reporting details of capital loss or gain transactions. Short-term transaction goes on page 1 of that form. Long-term transactions go on page 2. Again, that's nothing that you need to figure out. The software automatically pulls that information and reports it to the necessary forms and schedules based on the information you put into the system. All you have to do is to enter that data into TaxSlayer, and it does all the calculation and computing. Capital loss carryovers. I think I may have seen a capital loss carryover 1 or 2 times. Taxpayers can deduct capital losses up to the amount of their capital gains plus $3,000. A loss carryover can occur when losses exceed gains or when there is not enough taxable income to absorb the net loss deduction. The prior year's short-term and long-term carryover losses are combined with the capital gains and losses in the current year. Unused capital losses can be carried over to later years until they are completely used up. The most net capital losses taxpayer can take in a single year is again $3,000. It's $1,500 for merit filing separate. A previous year's return is needed to figure the capital loss carryover, and there is a worksheet. Their worksheet is available in the software, or you can find it in Schedule D instructions at irs.gov or in the software. There's forms and instructions there. If the loss is over the limit, the tax software reports the maximum allowable deduction. So you don't have to figure out or remember what the limit is, and that's as it relates to anything. The software automatically takes the limit as it relates to credits, deductions, or anything to that nature. Sale of a main home, again, is not something that's going to be common that you're going to see as it relates to the VITA TCE program. Taxpayers may be able to exclude from taxable income the gain from sale of a main home up to a maximum of $250,000, $500,000 for merit filing joint. Volunteers need to confirm the home sold was the taxpayer's main home and the taxpayer meets the ownership and use test. It refers you to the publication 523. The ownership and use test consists of a 5-year period ending on the date of the sale. The taxpayer must have lived in the home, or owned the home for at least 2 years, which is the ownership test, and lived in the home as his or her main home for at least 2 years, which is the use test. In addition, during the 2-year period ending on the date of the sale, the taxpayer must not have claimed an exclusion on a gain from the sale of another home. Again, this is not something that you're going to see very often, if at all. Figuring the gain or loss on the sale of a home is based on the selling price, the amount realized, the basis, and the adjusted basis. It refers you again to the publication 523. And it says to remember that the loss on the sale of a personal residence is not deductible. They can only take the gain. That information that is reported on the form 8949 and the Schedule D, and a taxpayer would have received the form 1099-S for either the gain or the loss on the sale of their main home. There is a 5-year test period suspension. The 5-year ownership and use period may be suspended during any period of qualified official extended duty for a taxpayer who is a member of Uniformed Services or Foreign Service of the U.S., intelligence community employee, or an employee or volunteer of the Peace Corps. If the taxpayer is on qualified official extended duty, they must serve at a duty station at least 50 miles from their main home or live in government quarters under government order, or they have been called to active duty for more than 90 days or an indefinite period. Out of scope for this lesson is taxpayers who have sold any assets other than stocks, mutual funds, or personal residence. Taxpayer who trade in options, futures, or other commodities, whether or not they dispose of any during the tax year. Taxpayers who must answer yes to the digital asset question on Form 1040. Determination of basis issues, like-kind exchanges and worthless securities. If they have a Form 1099-B, boxes on bartering checked. Reduced exclusion computations and determinations in the sale of a home. Married homeowners who do not meet all the requirements to claim the maximum exclusion on the sale of a home. If they had decreases to any basis, and taxpayers with non-qualified use issues, and a sale of a home used for business purposes or as rental property. Any questions or concerns as it relates to capital gains and losses? No? The time I have is 8:54, so I won't start another lesson because I don't want to stop in the middle of one. We will pick up tomorrow, on Thursday, on retirement income. We have a few more lessons as it relates to income. Then we'll get into credits and adjustments. And so I'll try to get through those as quick as I can, so that we can get to, in order to be able to cover as much as the advanced certification as possible. There was a question that asked, do the business taxpayers have to have an EIN instead of an SSN? No. And so, sole proprietorship businesses can use either their EIN or an SSN. And so it depends on whichever one they choose to use. They are not required to have an EIN. Someone asked about the PowerPoints, and the link was put in the chat for those PowerPoints if you want access to those.
I can share that real quick if that's all right, and kind of show them how to find that.
Yes.
Okay, so I'll put that link in there again. This is the student pathway for the advanced certification training on the IRS's website. So let me share my screen. So if you go to the website, this will be what it looks like, and this is really helpful. You can go into each of the lessons and kind of do skills workout, some more tutorials, some more hints, some skill check questions. But if you specifically want to get to the slides, what you'll do is you'll just go back here, click on the tab that says teacher, and you pick whatever lesson you want. So let's say we just looked at capital gains, so let's go there. And then you're going to go to teacher tools, go to instructor presentation. It pops up in a separate window, so I'm not sure if y'all are able to see that, but that'll open up the slides if you want to review the slides specifically.
Ms. Teresa, you have a question?
No.
Okay. Those lesson plans, those PowerPoints, the publication 4491, those resources are going to give you a lot more information than what those PowerPoints give. Those PowerPoints give, I think it hones in on the what they feel like are the important aspects of those lessons, which is why I try to go off of the 4491 when I'm going through those PowerPoints to give you all a little bit more information as it relates to the topics that we are covering. But if you want more in-depth information, or if you want to be able to go over that information, the PowerPoints are good, but I will refer you to the publication 4491 or to those lesson plans, or to the information that Hunter showed, because it will give you a more in-depth read of those topics. Those publications can be found at irs.gov. Any and all publications can be found at irs.gov. Hunter also just dropped it in the chat. Oh.
Ms. Rucker?
Mm-hmm.
Two questions. One, can we get into the practice version of TaxSlayer? And if so, how? And then I have a follow-up question.
Let me see if I can get into Link and Learn. What's your follow-up question while I'm trying to do that?
I actually did these a number of years ago, and I remember sometimes getting the name we enter on the 1040 to match the Social Security database can be a little challenging, especially with like refugee families we sometimes see in Binghamton. And I'm trying to remember, is there sort of a rule of thumb if they have 4 names, how you enter them in the fields? Does that ring any bells?
Yes. So are you saying if the Social Security card has 4 names?
Yes.
So what I would do is to ask the taxpayer, especially, so if it's what is considered their last name. So some will have, so if my name is LaQuisha Dion Rucker Fields, then what last name does the Social Security Administration know you by, or what's your legal last name? And so if Dion is considered the middle name, then if I'm able to put Rucker Fields as the last name, then put so that the software will still accept those 2 last names if it's a match. And so you'll just have to try to clarify with that taxpayer what their last name is, especially if the software is not going to allow you to enter all last names, or you may be able to put one as the middle name and then put the last 2 as a last name to see if the software once it's transmitted, if it will take it.
Okay.
It also helps if they happen to have a copy of any of their previous tax returns. I see what the IRS has accepted prior years, especially if they've done it with United Way, then we can just pull them up in TaxSlayer and see what got accepted last year.
Okay, thanks.
Hunter, are you able to log into no.
Are you wanting Link and Learn or the Practice Lab?
I just thought about that. Yeah. Okay.
The practice lab, just, or are we gonna cover the software operation Thursday?
Hold on, I can show you the practice lab. And so, are you able to see my screen?
Yes, ma'am.
Okay. And so, from your Link and Learn landing page, you don't even have to sign into Link and Learn in order to get access to the practice lab. The practice lab is located under your quick links. And so if you click practice lab, and so when you do the practice lab, you do have to have a password to enter here, and that password is Train Pro Web, all one word, all caps.
Train Pro Web. All caps.
All one word, all caps.
Okay.
And so once you enter that password, then you have to, if you have never been into the practice lab before, then you need to create an account. If you have previously been in the practice lab, you can use the same username and password as before. You don't have to create a new one unless you don't remember what that login information is. But if you've never been in it before, then you're going to create an account. You don't need the SIDN number, but you will answer all the other questions. Your password has to be, I think, 13 to 18, 15, minimum of 15, maximum of 25 characters when you're entering that password. But other than that, it's common you can pick your username, use your email address that you know you'll have access to. So if you forget what that username or password is, it'll send you a link. Let's see if I can. That's not what I'm doing. See if it'll let me in. And so once you create an account, or if you already have an account, then this is where it's going to take you to. And so all you have to do is to go to the practice area. And so the practice lab, it looks exactly like the live software that you're going to use when you start preparing the returns in TaxSlayer. And this is the practice. This is where and when you get ready to do your scenarios, your information for the advanced certification, and it gets to the point where it says this scenario requires you to input a return or to complete a return. That's what this is what it means, that you'll have to use the practice lab and use the information in the 6744 to complete a return.
Okay. And are we gonna go over that Thursday or?
Yes.
Okay, all right.
Yes. And so my hope is for us to be able to from 6 to 7 run through the last lessons that we have, take a break, and then come back and we dive right into the certification, and so that we'll have enough time to get through as many of the scenarios that we're able to, or for at least for me to complete one of the scenarios that requires a return, so that I can show you all what that looks like. The first, I think 6 scenarios or 5 scenarios don't require a return. And so we can go through and answer those questions after we've input us. But I do want us to go through at least one scenario where we use the information out of the 6744 and we walk through entering that scenario so that you all are able to see what that looks like.
Great. Thank you so much.
All right.
Ms. Rucker,
Mhm.
did you say that we can pick up a paperback copy of the publication 4491? Or
Hunter, did
We
you say
have,
that?
we do. We have some copies, physical copies of it at the United Way office. You can just email me to coordinate time to come pick those up if you want to pick some up.
okay, thank you so much.
You're welcome.
Any other questions or concerns? Yes, Ms. Sharon, you can use the practice lab. You can enter those returns as many times as you want using the publication 6744. All you have, so when you go into the 6744 and it gives you the documents you need to enter the return, it gives you the Social Security cards or numbers. And so so it'll have a number 1, 2, 3, 4, 5, then it has X's. Anywhere it has X's, you make up what those numbers can be. And so if you want to redo those returns again, or those scenarios, all you have to do is to change those numbers. And so if you use 1, 2, 3, 4, 5, 6, 7, 8, 9 the first time, then you can use 1, 2, 3, 4, 5, 0, 0, 0, 0 the second time. And so you're just changing those numbers in order for you to input it again. The Social Security number, that is.
Thank you.
Mm-hmm. I did input my email address, I think, in the box. Yes. And so if anyone has any questions outside of tonight, before Thursday, after Thursday, then shoot me an email. I am in training from 8 to 4:30. Tomorrow I do try to check it on breaks. But if you send me any type of question tonight, tomorrow, and I don't respond or have not responded during that time, then that's the reason. But I will try to get you a response after that training is done. All right.
Thank y'all. And I put it in the chat, but in case you didn't see it, we will spend time making the practice lab accounts on Thursday's session. But if you do want to go ahead and make one now, when it asks you the program type, you're going to select VITA, VITA. But like I said, we'll do that in Thursday's session. So don't worry about that for now. But if you do want to go ahead and make one, when it asks you for program type, that's going to be VITA. Well, thank y'all. Ms. Rucker, thank you so much. And thank y'all for being here. Looking forward to next week, or not next week, Thursday. Looking forward to Thursday and for leading this new volunteer training. So I appreciate y'all being here. Ms. Rucker, again, thank you so much for just your thoroughness and your patience and for taking us through all this material.
No,
All
you
right.
are. So
Thank
reach out if
you.
you have any questions, and I will see you all on Thursday.
Thank
All right,
you.
thank you.
All righty. Have a good one.
You
Have a
too.
good evening.